Hello and welcome to your first lecture in Management Accounting Applications. I'm Dr. Martin Roberts and I will be taking you through, in this first part of Lecture 1, the very basics of Management Accounting. Okay, just before we do that, I just thought I'd introduce myself. You should have seen some of my videos of myself and my team on the Blackboard site, but for those of you who still haven't done that, hope you do, please, and you do it soon. This is whom I am, and there are my qualifications. Obviously BA Honours is what you are attempting to achieve in your 3 to 4 years with us, followed by a Masters, followed by a PhD, followed by educational certificates. But the ones that give me credibility to give you a good solid grounding in management accounting for your placement and beyond is these two last acronyms, FCMA and CGMA. FCMA stands for Fellow Chartered Management Accountants. CGMA stands for Chartered Global Management Accountants. FCMA means that I've been a finance director. Okay, that's my current title. That's the email address you can get me at, and these are my previous experiences. Okay, so I've been a finance director. I've run my own company. I work for professional bodies, and there's some of the big names that I've worked for. I've been very lucky to work for. So in terms of basic accounting, apologies, this might be a bit of a repeat if you've looked at my earlier lecture on the basics of management accounting, but I thought I would add just a little bit more, and possibly to do this for somebody who thought I won't need it, but I'd rather we started from the beginning. So, things to know about is that when we're talking about managing accounting, managing finance, is that what we need to understand, the best place to start is that companies file their annual accounts at Companies House, and the biggest of those, such as the ones I've had the good fortune to work for, will make those accounts public, and you can actually find those type of annual reports in the library. Okay. And bizarrely enough, of the huge level of reports, we only actually need about 2 pages of the entire annual report. And the first statement we're interested in is the income statement. It looks at profits generated at the year. It starts at 0 and accumulates to creating at the end of 12 months a profitable position. So when you're seeing the news and you hear things whereby certain companies have made £3 billion in profits, that means they've done it from 0 within 12 months, which is a considerable achievement. Okay, so a little simpler type of income statement. What you look at and compare is this year versus last year, and you start with sales, less your cost of sales to make the product, giving you a gross profit. And then you have enough profit to cover your overheads, which again, if you follow your financial accounting, you'll see that your overheads have to be redefined into these 2 categories, and that's just to keep up with statutory law. Beyond operating profit, the rest is really where you come in as a finance director. You will be working on your interest receivable from any cash that you've got and invested, and interest payable is the loans that you have outstanding and obviously the interest that you pay on it, and then hopefully you paying your tax on any profits that you make. Okay, the next important page within an annual report is the balance sheet. Okay, and again, what that does is it balances your shares, the amount you have invested, plus any previous profit or loss against your net assets. Okay, and hopefully from that, what in essence that does is that just shows you how well your investment has been managed over time. Okay, so what you should see are two numbers the same. So for this year 62 million and for last year 61 million, and what that's saying is that there's 62 million invested in the company. That is in terms of how much shares have been put in, 50 million, plus retained profits from previous years of 12, making the 62. Where has that gone? So it's gone into fixed assets, which is machinery, that type of thing, stock or your inventory, debtors, people who owe you, that's otherwise known as receivables, cash, and then finally people you owe, your liabilities or your payables, or indeed your creditors as they're known. So, okay, what's the aim? The aim is to maximize shareholder wealth, okay? And we're going to focus on that. How much profit we can make with the investment we're given, okay? We're not going to focus so much on the balance sheet. We will focus on the income statements. We will look at turnover. We will look at budgets. We will look at variances. We will then, in the last couple of weeks, we will look at how you turn profit into cash by using working capital management. Okay, so I mentioned previously is really we're only going to go down to where that red circle is. We're going to concentrate on turnover, cost of sales and our overheads. We're not going to go any further than that in our studies in these next 12 weeks, which sounds amazing, but these numbers here and how we control them, it takes a lot of doing, especially in large organisations, and I'll take you through, and my team will take you through quite what measures we use. Okay, so what I think will now show you what I mean by how incredibly detailed it becomes. Let's show you some more detail related to that income statement. Okay, so we will have that income statement and we will compare it to budget. Okay, and we want it to be forward thinking rather than backward thinking or reactive. We want you to be able to influence the numbers, not react to a problem. Okay, and so there you go. As I mentioned, is we've moved from very formal financial accounts that we present at the end of the year to something that we manage on a sort of daily, weekly, monthly basis. It's something like this within a spreadsheet. And what we will do is we will break this down even further so that you can have a lot of control over your organization. Okay, so what happens is these informal numbers generated via your trial balances and your general ledgers will eventually turn, and you will influence the turn into your finished financial accounts that you present in your formal income statements at the end of the year. Okay, so something that's fairly informal now becomes even more informal, but even more detailed. Okay, and it looks like that. There you go. So when we presented that 4 million profit on our financial statements in a very simplistic basis, is that what you can see is that's been built up over months, that you will have managed to make sure, one, it's correct, everything's posted in the right place, and then secondly, you will be aiming that gets towards budget, or in this case at least profitability, because we didn't hit budget. Okay. Okay, so what happens then is that's not all of it. You will start to break it down in individual sections, and you'll start to see things like that. This will probably be the type of thing that you do in your first job, whereby your cost centers are broken down month by month, line by line, that go and build up the bigger pictures that you see. So it's incredibly detailed, and that's why you're paid a lot of money to make sure, one, it's right, two, you understand what it means, and three, you help your non-financial managers through so that they understand their budgets. Okay. So, like I said, is you as a representative of the finance department will discuss that piece of paper, looking at all that I've mentioned, okay, and also understanding accruals and prepayments. So that's something that if you don't understand, please feel free to ask me or a member of the team, and we'll take you through what they mean, because some people still struggle with that once they leave university. Okay. And so this is what, in essence, we should be doing. We compare actual against budget, we have a variance analysis, we help other teams do performance appraisals, so we say is it good or is it bad, and then whether it's good or bad, we take action, and that feeds back round in a big circle to influence our budgets and to influence our future actuals, and we keep going in that perpetual motion. Okay, like I said, we're asked to maximise shareholder wealth. And so how do we judge shareholder wealth? We use this acronym. Okay? Very, very rare that anyone will say, how's your ROCE? Most people will say ROCE. Okay? So that stands for return on capital employed, and is a very simple formula. You take your operating profit of your income statement, and what you do then is you then put that profit over your capital employed, over your investment in essence. So it brings the two financial statements together. There's your operating profit of your profit and loss or your income statement, and then your capital employed is from your balance sheet. And what it's trying to say to you is that for every pound investment you will get a certain return. So we'll have a look and see what happens in the examples we've used. So there you go. There's your operating profit, and there's your capital. Okay, so for the £62 million invested, we've made £4 million in operating profit. So our return on capital employed is 6.45%. And you've got to ask yourself, well, is that a good return? If you've got your money in the bank and you're getting very little return at the moment, then that's fantastic. But in relation to the industry this company is in, that could be absolutely terrible, and they really are underperforming. So again, it's about looking at external circumstance and comparing against your competitors. Okay. So there we are, there's this first part of this lecture dealt with, and it's all about this idea of maximising shareholder wealth, but it's going to be a balance. It's going to be a balance between profit and cash. You want as much profit as possible, but you also need as much cash as possible in order to run the business successfully. So where we're going to go on to next is we're going to look at multiple product break-even.